Welcome back to another accounting video dealing with stockholders' equity section. We're going to look at an exercise in which we're going to issue common stock, preferred stock, and then buy back some of our common stock, which we call treasury stock. So let me start with a quick screen share. Okay, so in this exercise, we have this company that had the following transactions. On March 2nd, they issued 5,000 shares, $5 par value common stock to an attorney in payment of a bill for $30,000 for services performed in helping the company to incorporate. So this is an example of a non-cash transaction. We received services. Instead of paying cash, we gave them shares. The shares are worth, the par value is $5 each. And we're going to see how we're going to do the journal entry for this one. So to start with, the date of issue is March 2nd. On this date, we did not receive cash. What we're trading for is an expense. The organizational cost we'll call organizational expense. And that is, the value is $30,000. That was the invoice that we got from the attorney. And we are instead giving shares. The par value is $5. So common stock can be credited only at par. So $5 par value. And I will credit that a total of $25,000. That's 5,000 shares times $5. Obviously, I am short on the credit side, and we're looking at $5 over there. So this is in excess of par. So basically what we're saying over here is, instead of giving the attorney the 5,000 shares, if I had sold those 5,000 shares in the market, I would have got $6 per share, an extra dollar above par. And that number is going to be credited to paid in capital in excess of par. Now, I have a small calculation here going on this side, and I'll show you what that is. First, I have the date. I'm going to identify how many shares I've issued. I'm talking about only the number of shares. So I have 5,000 shares that are issued. Then let's continue with the exercise. On June 12th, we issued 60,000 shares. Par value is again $5. And we received cash, $375,000. So let's see how we're going to do this. First, we write the date. Now, in this case, we received cash. So cash is debit. We know the amount of cash we received. It's $375. Common stock, how much can be credited? Only at par value. Again, the par value is $5 that was given to us, and that's what we're going to go with. Okay. 60,000 times 5 is 300,000 is the par value. So the difference of $75,000, that is paid in capital in excess of par for the common stock. Now you would notice over here, I've written paid in capital in excess of par, comma, common, because if a company has common stock and preferred stock, you have to keep these in separate accounts. Now these two transactions related to common stock. Now again, I'm going to write the date over here, and I have 60,000 shares that are issued. Let's continue reading the exercise. On July 11th, I issued 1,000 shares, $100 par value preferred stock at $110 per share. So this is a different type of stock I'm issuing. It's called preferred stock. Their preference is to dividends and in the event of liquidation. So right now I'm doing the issuance of the stock. I received cash. Again, cash is debit. How much cash did I receive? 1,000 shares times 110. That's the selling price. So 1,000 times 110 gives me $110,000. How much will I credit the preferred stock? Only at the $100 par value. So as you would notice over here, the par value of the common stock has nothing to do with the par value of the preferred stock. They're completely separate. So this amount is going to be $100,000 because it's the 1,000 shares times 100, giving me $100,000. The extra $10,000 is going to be credited to paid in capital in excess of par for preferred stock. Once again, we're keeping these as separate accounts. Now, is that going to be listed over here? The answer is no, because this is just a track. I'm keeping a track of my common stock, not my preferred stock. On November 28th, I purchased 2,000 shares of treasury stock for $80,000. So let's take a minute over here to go through this treasury stock, what it means. When a company issues stocks, they have sold ownership in the company. Those stocks after that point of time, if they're publicly traded, anyone in the open market can buy those shares, including the company themselves. So let's say, for instance, this company is Verizon. They've sold 1 million shares. And a year down the road, they bought back 10,000 shares. Those 10,000 shares that they bought back, it is not an investment. You can't invest in your own company. It's common stock that was outstanding, but now I have bought it back. So effectively what that does is it decreases the shares outstanding. They are still technically issued shares. So we will put it into a separate account called treasury stock. So treasury stock debit and cash credit. How much did I pay? I paid 80,000. What could I do with the treasury shares? This common stock that I hold, my own common stock, I'm the company. I could resell the shares in the market. I could give it to my employees. Typically, it's given to the board of directors, the top executives as compensation. You would give it to them. You could choose to retire the stocks if you want to subsequently. The most common reason a company will buy back their shares, the two most common reasons. The one we hope for is they're buying these shares because they want to give it to their own employees. The second reason a company would buy back their own shares is that the shares are trading at a very low price. If I buy back my shares, then there are fewer shares out in the market, and hopefully that drives the price up. Remember, demand and supply. If there are more of my shares out there, the prices drop. If I take some out of the market, then hopefully the price goes up. So the reason this is important, the calculation I'm doing over here is, again, remember we're doing only the common shares. I had 5,000 over here, and then another 60,000 I issued. So I have a total of 60,000 shares that were issued. This was sold to the public. How many did I buy back? I bought back 2,000 shares. This happened on November 28th. These 2,000 shares reduce the number of shares outstanding, and the number of shares I have outstanding at this point of time are only 63,000 shares outstanding. So the number of shares outstanding has decreased. This calculation is important because if a company decides to pay out dividends to their common shareholders, they will pay it only to the outstanding shares, not the issued shares. Because if they give it to all 65,000, they will effectively be giving themselves dividends, and that's not allowed. Only to the shares outstanding, which is why you want to have this calculation going. Once again, these 2,000 shares, a company could choose to reissue them, which means sell it out again. They could give it to their employees, or they could retire the shares. All of those are possible. So this again is another quick example we have of sale of common and preferred stock and buyback of our own stock. The next exercise will look at paying dividends.